When you close your eyes and picture Charlie Munger, what's the image that, immediately comes to mind?
It's the icon, right? The 99-year-old sage, thick glasses, that suit that looks comfortable but expensive, sitting on stage next to Warren Buffett.
In an arena with like 40,000 people?
Exactly. Sipping a Coke and dropping these one-liners that just completely destroy entire economic theories.
Right. We see the oracle. We see the billionaire with a B. But here's the thing that just drives me crazy about the usual narrative.
Yeah.
We see the result, but we almost never talk about the engine that got him there.
You mean seed capital, the initial fuel?
I mean, the first million. Because let's be honest, you can't just walk up to Warren Buffett in 1960 and say, hey, let's be partners if you don't have chips to put on the table.
Right.
And Munger, well, he wasn't born with those chips. He didn't inherit a trust fund.
That's right. And the how is actually a lot grittier than people realize. It wasn't just, picking stocks. In fact, if Munger had stuck to just picking stocks with the little money he saved from his paycheck, we might never have heard of him.
It wasn't the stock market at all, not initially. And it definitely wasn't his day job as a lawyer. So that is our mission for this deep dive. We are going to strip away the Berkshire Hathaway legend and go back to 1960s California. We are going to unpack the specific mathematical blueprint Charlie Munger used to move from selling his time by the hour to building massive equity.
It's really a masterclass in two things: leverage and velocity. And honestly, it's a strategy that is, well, it's terrifyingly aggressive compared to the safe investing advice we usually hear.
We're going to get into the math of that because it is surprisingly aggressive. But before we decode Munger's past strategies, we have to touch on the present for just a second.
Sure.
If you are trying to follow in these giants' footsteps, you need to know the temperature of the room you're walking into right now.
Context is everything. You don't want to be aggressive when the market is screaming danger.
Exactly. And to track total market temperature right now, we recommend you search and download the iOS app Buffett Indicator from the Apple App Store.
Oh, yeah.
It provides daily alerts on the Buffett Indicator to help monitor market bubbles. It's essential for anyone looking for value in a noisy world.
It's a great tool. It really keeps you honest about valuation so you don't get swept up in the hype.
So let's set the stage. The year is 1948. Charlie Munger graduates from Harvard Law School, magna cum laude.
The best of the best.
He is brilliant. He is hardworking. He lands a job at a prestigious firm in Los Angeles. By every standard of the 1950s American dream, he has won the game.
On paper, absolutely. He's in the elite. He has the pedigree, the job, the status.
Yeah.
But Munger had this unique ability to look at a situation, even a successful one, and just deconstruct it to find the structural flaw.
And he found one.
Oh, yeah. He realized pretty quickly that he had walked into a trap.
A trap. He's a Harvard lawyer making good money in the post-war boom. I mean, most people would kill for that kind of trap.
It's the linear trap. And this is the fundamental problem with professional services. Whether you're a high-powered lawyer, a consultant, or, a specialized surgeon, you are selling your time for money.
The tyranny of the hourly rate.
Right. And let's say Munger was billing in today's dollars, $500 or even $1,000 an hour. That sounds great.
That sounds amazing.
But it is mathematically capped. There are only 24 hours in a day. Even if you never sleep, your income has a hard ceiling.
So if Munger stops working, the money stops flowing.
Exactly. It's a linear equation. Input time equals output cash. There is zero leverage. If he takes a vacation, he loses money. If he gets sick, he loses money.
And knowing Munger's personality, this obsession with efficiency and compounding, that inefficiency must have been agonizing.
Oh, it drove him nuts. It's like driving a Ferrari in a school zone. There's a famous quote from him about this period. He said, "I didn't want my client to decide my future. I wanted to decide it myself."
He wanted out.
He realized that to have true independence, what he called financial dignity, he needed to decouple his income from his effort. He needed a machine that worked while he slept.
And he realized that wealth isn't built by high income. It's built by owning equity.
Exactly. He needed two things to break out of the trap: capital and leverage.
Okay, capital and leverage. But here's the problem. He's a young lawyer with a big family to feed. He doesn't have capital. He has cash flow, maybe, but not a giant pile of money. So how does he make that leap?
Well, the opportunity presents itself in the early 1960s, and the setting is crucial here. We are in Pasadena, California.
The Golden State in its golden era.
Specifically, a massive macro trend, a population boom. Post-war America is just flooding into California. The weather, the aerospace jobs, the lifestyle.
Right.
And when you have a tidal wave of people moving to a specific zip code, what is the one thing they all need immediately?
A roof over their heads.
Housing. Munger looked at the data. And remember, he's a data guy. And he saw this massive supply and demand imbalance. There were too many people and not enough apartments, especially close to universities like Caltech and the job centers.
So, simple economics 101. High demand, low supply. prices have to go up.
Right. So he decides to partner up with a client of his, actually, and develop apartment projects. Now, I want to pause here because I think most listeners tune out when they hear real estate development.
Yeah, they think it's just for tycoons or people with hard hats.
Or they think it's about fixing toilets at 2 a.m.
Right.
But Munger didn't approach this like a landlord. He approached it like a mathematician. He looked at the deal structure and realized he could manufacture returns that were, well, they were impossible in the stock market.
Okay, this is the part of the deep dive where we need to slow down and really look at the numbers. Because the way he structured these deals, that's the secret sauce. It wasn't just buying a house and hoping it went up in value.
No, not at all. It was an arbitrage. Let's walk through the math breakdown. We'll simplify the numbers to make it crystal clear based on the examples from the source material.
Okay, walk me through the Munger math. Let's pretend I'm Munger in 1961.
Okay. Imagine a single apartment project. Let's call it Project Alpha. It costs $100,000 to build. This includes the land, the concrete, the lumber, the labor, everything.
Got it. $100K all-in cost.
Now, let's say you build it, and the market value upon completion is $120,000, so you sell it immediately. You are not keeping it to rent it out for 30 years. You are building and selling.
Okay, so $120 sales price minus the $100K cost. That's a $20,000 profit.
Correct. Now, if you did this the safe way, the unleveraged way, you would have taken $100,000 of your own hard-earned cash, built the thing, and made 20 grand. That is a 20% return on investment.
Which isn't bad. I mean, 20% beats the S&P 500 in most years. If I made 20% on my portfolio consistently, I'd be happy.
It's good. But is it life-changing? No. Does it turn a lawyer into a billionaire? No way. It's too slow. Munger needed velocity, and he didn't have the 100 grand cash to begin with.
So what did he do differently?
He applied leverage. He went to the bank. In this scenario, Munger and his partners wouldn't put up the full $100,000. They might only put up, say, $20,000 of their own money. This is their equity.
Okay, so they have skin in the game, $20,000, but they need $100,000 to pay the contractors. Where does the other $80,000 come from?
The bank. They borrow the $80,000 as a construction loan. They build the project. The total cost is still $100,000. The building is exactly the same. They sell it for the same price, $120,000.
Okay.
So closing day comes. They get the $120 check from the buyer. What happens first?
The bank gets paid. They want their 80 grand back.
Right. Bank takes $80,000. You are left with $40,000. Now, think about your initial investment. You put in $20,000. You walked away with $40,000.
You doubled your money.
You made a 100% return on equity. The project's profitability didn't change. It was still a 20% margin on the asset. But your return on equity skyrocketed because you used other people's money to fund the bulk of the cost.
That is the magic of the equity multiplier. You're earning the profit on the whole building, but only if it's for a fraction of it.
Precisely. It acts as a magnifier. And Munger saw this mathematical certainty. And this is a big if, he could ensure the project sold quickly and at the right price. The returns would be astronomical compared to billing hours.
But wait, you said if he could ensure the project sold, that's the catch, isn't it? Real estate is competitive. If the market dips or if nobody wants your apartments.
That leverage works in reverse.
You still owe the bank.
That is the risk.
Yeah.
And this brings us to the second type of leverage Munger used. We talked about financial leverage. Now we have to talk about intellectual leverage.
Intellectual leverage. I like that.
Yeah.
So how did he outsmart the other developers? Because Munger had zero experience in construction. Right. He's a lawyer.
Zero. But he had taste and he had logic. Look at the landscape at the time. Most developers were greedy. Land in California was getting expensive. So the prevailing wisdom, the herd mentality, was to build high-density multi-story boxes.
Cram as many units as possible onto the lot. Minimize land cost per unit. It's an efficiency play.
It's an efficiency play on a spreadsheet. But the result was these cramped, uninspiring concrete boxes, dark corridors, no yards, shared walls on every side. They were ugly. Munger, being Munger, inverted the problem.
Invert, always invert.
He asked, if I lived here, what would I want? He put himself in the customer's shoes, and he realized that people moving to California wanted the California dream. They wanted light, they wanted air, they wanted a connection to the ground. They didn't move to Pasadena to live in a dark tower.
So he went against the grain.
Completely. While everyone was building up, Munger built out. He built one-story, maybe two-story garden apartments.
Wait, doesn't that hurt the math? Fewer units on the same expensive land.
It hurts the density math, yes. But Munger prioritized excellent lighting, extensive landscaping, green space, and privacy. He made them genuinely pleasant places to live.
He built a better product.
A significantly better product. And the payoff was twofold. First, yes, he could charge a premium price because they were nicer, but the second payoff is the one that really mattered for his wealth compounding. He could sell them faster.
Ah, velocity again.
In the internal rate of return, the IRR calculation, time is the enemy. Every month a unit sits empty, you are paying interest to the bank, and your equity is trapped.
Right.
While his competitors were sitting on unsold units in their ugly towers, Munger's units were selling out immediately, sometimes before they were even finished.
So he got his capital back, his initial 20 grand, plus the profit in, say, 6 months instead of 12.
Exactly. And because he got it back faster, he could roll it into the next deal sooner.
So he combined financial leverage using the bank's money with a superior product strategy that minimized his risk of holding the asset too long.
That's the genius. It wasn't just gambling with debt. He skewed the odds in his favor by having the best product in a hungry market. He essentially de-risked the leverage by ensuring demand.
So he's got the formula. Leverage plus good product equals big returns. What do you do next? Do you just sit on the cash?
This is Charlie Munger we're talking about. He didn't buy a yacht. He didn't buy a Ferrari. He initiated the snowball.
A snowball.
Between 1961 and 1964, a very short window, really just 3 or 4 years, he rinsed and repeated this process roughly 5 times.
5 projects.
And he didn't take the profits out to spend on lifestyle. He let the money compound. He rolled the principal plus the profit from Project A into Project B, which was bigger, then rolled all of that into Project C.
It's the 8th wonder of the world, compounding. But usually compounding takes decades. Munger was doing it in months.
Because of the leverage. He was compounding at rates of 100% or more per project.
So what was the tally at the end of this run? He starts with practically nothing in 1961. Where is he in 1964?
In just those few years, he turned his initial scraps of capital into $1.4 million in cash.
1.4 million. Now we have to pause and adjust for inflation. $1.4 million in 1964. That's not $1.4 million today.
No. Depending on how you calculate it, that is equivalent to well over $10 million, maybe closer to 12 or 13 million in today's purchasing power.
So in 3 years, doing a side hustle while working as a lawyer, he made $10 million.
Correct. He was independently wealthy. He never had to work another day in his life if he didn't want to. He had secured his freedom.
But then something interesting happens. And I think this is the part of the story that is most relevant to investors today. The source mentions a sudden stop. He's making 100% returns. The market is still hot. He's the king of Pasadena real estate. Why did he stop?
This is perhaps the most important lesson for the listener. Munger stopped cold. He walked away from development completely.
Why? Greed usually tells you to keep going. I'm good at this. Let's just do bigger buildings.
Because he understood the dark side of leverage. He knew that while leverage multiplies your gains, it also multiplies your losses. And crucially, in those days, these construction loans were often recourse debt.
Meaning he was personally on the hook.
If the market turned or interest rates spiked or a project stalled and he couldn't pay back the bank, he wouldn't just lose his profit. The bank could come after his personal assets.
He could lose everything.
He could lose the $1.4 million he had just made. He could go back to zero. He realized the asymmetry had shifted. He had more to lose than to gain.
He had reached escape velocity.
Exactly. He had the seed capital he needed, that $1.4 million, to play a different game. A game where he didn't need to sign personal guarantees on construction loans. A game of buying businesses, stocks.
Right. He took that money, founded his investment partnership, and eventually that money merged into the Berkshire Hathaway universe. That real estate money is the grandfather of the billions we see today.
I love that. He used real estate not as a career, but as a vehicle. A specific tool to get to the starting line of his true career.
Precisely. It was a means to an end. He climbed the ladder and then he kicked it away.
So what does this all mean for us, for the listener driving to work or at the gym right now? I mean, this is a story of 1960s real estate, but most of us aren't going to go build garden apartments in Pasadena.
Right. How do we apply the Munger method today?
I think there are 3 huge takeaways here that apply to almost any field, whether you're in tech, sales, or investing.
Let's hit them. Takeaway number 1.
Number 1, the first bucket is the hardest. Munger has always said that the first $100,000, or in today's money, maybe the first significant nest egg, is the most painful to earn.
Because you have no leverage yet. You're just pushing the boulder.
You are pushing a boulder uphill. You have to be extremely frugal, work incredibly hard, or find a side hustle like Munger did to accumulate that initial capital. You can't invest capital you don't have. There is no magic trick to skipping this step. You have to grind before you can compound.
It's the unglamorous truth. Munger was working law all day and doing real estate deals at night and on weekends.
Takeaway number 2, respect leverage. Notice I didn't say fear leverage or love leverage. Respect it.
Munger used it to get rich, then stopped using it to stay rich.
That's the key distinction. Most people get it wrong in one of two ways. They either never use leverage because they are too scared, so they stay in the linear trap forever, or they use leverage, get rich, get addicted to the easy returns, and then blow themselves up when the cycle turns.
That's the smart money trap. When you're winning, you just want to double down.
And that's how you go broke. Munger knew when to walk away from the table. He used leverage as a booster rocket to get to orbit, then he jettisoned the rocket.
And the third takeaway.
Asymmetric opportunities. Munger didn't just buy random buildings. He identified a massive macro tailwind population growth and combined it with a superior product design.
He stacked the deck.
He ensured a high win rate. He wasn't gambling. He was executing a business plan where he knew he had an edge. If you can find a situation where you have a tailwind, maybe it's AI right now, maybe it's a specific niche in your industry, and you have a better product or skill set, that is where you apply the leverage.
It sounds so simple when you break it down like that, but it requires a lot of independent thinking.
As the source says, success is often just simple concepts plus execution. But the execution is the hard part.
Aggressive execution. Munger wasn't passive. He was building, designing, borrowing, selling. He was all in.
He was, and he was willing to look foolish to his law partners who probably thought, why is Charlie messing around with concrete?
So here's a provocative thought to leave you with. We often look for the magic bullet in investing, the secret stock tip, the new crypto coin. But Munger's wealth, the foundation of it, came from looking at a very boring problem. People need a place to live.
And solving it slightly better than the guy next door.
Using the bank's money to amplify the result. It raises the question, what is the boring problem in front of you right now that everyone else is ignoring or solving poorly?
And do you have the guts to borrow against your conviction to solve it? That's the Munger challenge.
Indeed. Before we sign off, a quick reminder.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And hey, if you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join the Deep Value Club membership or subscribe to us on Apple, Spotify Podcasts channel, Deep Value Investing, and luluvc.com.
We'd love to see you there.
Go find your